Now, in the previous video, I showed you guys how to calculate the pay for one employee, but now I'm going to show you how to calculate the pay for really a small company. And in this case, it's a small company with 7 employees. And this is also the question that you can expect if you are going to write the exam in payroll and monthly SARS returns. So let's see how you deal with this question. First, let us look at what you got. It says you have been provided with the following information for cotton jacks for the month of December. And basically, the only thing they give you is the employee number. In this case, this company doesn't want the clerk to know who's getting paid what. And so they give it numbers, but he will be able to guess, I guess, if he knows how old the people is. And then they give the age. The age is important, remember, because it tells us whether the guy is going to get a primary rebate only, or whether he's going to get a primary and a secondary rebate, or in the case of this old man that's already 75, he will get the primary, the secondary, and the tertiary rebate. Who, I don't know, maybe it's a woman. So then they give you the monthly salary, the basis monthly salary, or the basic salary for each one. They indicate to you whether there's a travel allowance applicable, and you can already, just by looking at the table, see there is an applicable travel allowance. They tell you whether the guy got any commission during the month or not, and they tell you what the totals are. So that is what you get. Okay, and then you get the rest of the table where they ask you about the travel allowance, the use of the company car, the medical aid, the pension fund deduction, what is the pay-as-you-earn remuneration, what's the UIF remuneration, and finally, what is the pay-as-you-earn that each one of these employees must pay. But in all cases, it's either just a 0 or it's a question mark. So really, you only deal with this information in the first table as the given information, but you get additional information. You get a tax table. You will always get the tax table. And remember, year to year, this ends. We're working 29 February 2020. It's a couple of years back. And then you are told the following. It says both 1001 and 3003 receives a guaranteed 13th check. Okay. So keep that in mind, because when you are now going to start to work on your solution, let me just show you here, you are going to make little notes on the side. See, once again, this is just now in Excel, so I've given you again what you received, and everything else I left it blank. And now we are beginning to make little notes. We say that as far as employee 1 and employee 3 is concerned, both of them are getting a 13th check. And I just made little 13, just indicate little 13 there in the notes, and you will be able to do that in your boundary on your paper. Good. Let's go back to the question. Then it says 2002 has the full use of the company car. Yeah, well, we knew that already, because in the question, if we go back here, that's the only place where there is a question mark, and the rest was either 0 or not allowed. But we are, in any case, we are still going to make that little note. So we say, I just said CC for company car only applies to employee 202. Okay, let's go back to the question. And then they give you a lot of details about the company car. It cost 175,500. That's inclusive of that. The monthly taxable benefit is 3.5%. And here they don't even say to us how we used it. From the beginning, they tell us 80% must be included in when we determine the pay-as-you-earn. So we can work with 80% from the outset. It then says that all permanent employees contribute 7.5% of their basic salary to the HG pension fund. 13th check are also pensionable, and Cotton Jacks contributes to the pension fund on a rand by rand basis. So in this case, it's easier. Simply 7.5% of the basic salary, and the company contributes exactly the same. Okay. Then it says here 6006 and 7007 are part-time employees that worked for 34 and 20 hours in the month respectively. Now, when I go to my answer here, in my employee number, I actually already indicated to you that these are full-time workers, FT, 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 and these two are part-time workers, the 21-year-old and the 18-year-old. Okay. Then you will see in the banner here, I said 25%, 34 hours and 25% 20 hours. Why is that important? Because the moment somebody is a part-time employee, you are going to tax them at a rate of 25%. And if that was too much, they must sort it out with SARS at the end of the year. And these are just indications of the number of hours they worked. And there's a reason for that, because the theory will tell us that if you work for 24 hours or more in a month, then UIF is payable. But if you work less than 24, and 20 is most certainly less than 24, then you do not pay UIF. And then for all the other guys, you see I said here 7.5% pension times 2. So that's my notes that I've made. Is there anything else that's important that they give us? Let us see here. They say as far as let's get here, there are no independent contractors or employees on registered learnerships. That's good news for us, and it is to save paper on the side of the examiner, because if we had people that acted as independent contractors, or if we had people on learnerships, then the pay-as-you-earn remuneration and the STL remuneration would be different, because we would have to take those guys out when we calculate the STL remuneration. Okay, that is why they tell us that. Okay, what else do we know? It says here 80% of the travel allowance is taxable, so that whenever we see that somebody has a travel allowance, we will simply multiply it by 80%. We are assuming a maximum UIF funding salary of 14,872. So the moment people earn considerably more than this, that is the amount we will simply put in there, and we won't go through a lot of calculations. Then it says all permanent members belong to the medical aid. Okay, and the company pays the whole contribution to the medical aid. And then they say the following tax rebates apply to medical fund contribution. They say 310 for the sole member, 310 for the first additional dependent, and then 209 for every other dependent. Okay, now what's important here, and they don't say it here, they do say it below, is that this is a monthly rebate. Okay, so here there's also other rebates that's applicable, as you remember. No, I don't think they gave it to us there. The normal rebates here, that's applicable, and these rebates is applied before we divide it by 12 to get the monthly amount. These amounts here, the 310, the 310, 209s, those are subtracted only once we've calculated everything else. Okay, then they say to us here that the number of dependents of each one is 0 for 101, 3 for 202, 1 for 3003, and so forth. But what you must realize is that these are not the number of people on the medical aid, because it doesn't list the main member. So you must always add 1 year when you do those monthly deductions. Okay. The rebates allowed in the South African tax system are as follows. For the tax year, they give you the value of the primary rebate, the secondary rebate, and the tertiary rebate. And just a reminder, everybody under 65 gets only the primary rebate. People between 65 and 74 get additional rebate of 7794. So the person that's over 60 get the 14,000 plus the almost 8. And then the tertiary rebate for people that are 75 years and older, they get an additional 2,500 per month as a rebate. Then they say two things that we must do. We must complete the table provided in the answer book, and you already saw that a couple of times now. And we must complete the abbreviated EMP 201, and we must show all calculations. Okay, now let's go and look at the solution. So, first thing we do is we have a look at the travel allowance that is taxable. Okay, but before we do it, I just want to show you something. When we calculate the pay as you earn and the STL remuneration, there is a formula. We take the salary, we add the commission, we add the taxable portion of the travel allowance, we add the taxable portion of the use of a company car, we add the medical aid that the company is paying, we add the pension fund that the company is paying, and then we deduct the pension fund that both the company and the member is paying. So the amount that we are going to deduct here will always be 2 times the amount that we listed here, and that will give us our STL remuneration. For UIF, we must ignore the commission, so we do not add the commission, and we must ignore the pension fund deduction. Now, the way to do that is, rather than doing the entire calculation again, is you take your pay as you earn remuneration, and you now subtract the commission that you added previously, and you add the pension fund deduction that you subtracted previously, and that will give you UIF remuneration. But in most of the cases, you are just going to write in that amount that they gave us there of 14,872. Okay, let's get back here. So, also, before we even start doing this, let's just explain to you, you can never get both a travel allowance and the use of a company car. It's either one of the two. Okay, so now, when we get to the use of the company car, we know that if there was a travel allowance, we must just multiply it with 80%. So I just referred back to the travel allowance column, and I said, okay, let's multiply that by 80%. And then we got 1,508. Now, if I drag that down, it will fill it in for everybody. Okay, now let me undo that because I've actually got this here already. I just didn't reveal it to you yet. So let's have a look at that. That's when we add all of them. And what happens now, if somebody doesn't get a travel allowance, it will just show up as a naught. But it makes the calculations easier. So whether you put a 0 in there or whether you put a not applicable in there, both will be fine. Okay, and then of course, once we've put in all the numbers for that column, we are going to total it. And we've done that. Okay, now we look at the use of the company car. Now we know there's only one guy that uses a company car, and that is number 2. Okay, but now what I've done here to make it a little bit easier for you, I've given you what I call the company car calculator, just so that we don't have to move between documents the whole time. So the value of the company car, inclusive of VAT, when it was allocated to him last year, was 175,500. Okay, the monthly rate was given to us at 3.5%. And they said to us that we must use the 80%. So it's not, the use is not even applicable. Normally they would have told us it's 50-50, and then we would have put the 80% in there ourselves. But in this case, they said work with 80%. Okay, now if we have these 3 amounts, we simply multiply them one after the other, and we get to the answer. Just a reminder here that always when I click on a little block and I haven't revealed the answer to you yet, the formula is there in the formula bar. So you can stop the video and then go and look at the formula should you need to. Okay, so now that we've done that, we can just add that amount in for number 2 and put a 0 next to all the others. And then when we get to there, we simply add all up to sum the column. Now, what about the medical aid? Because how do we know which part of the medical aid is taxable? Well, we do know, because medical aid that the company pays is 100% taxable. And if we go back to our question paper, you will see that here they gave us the amount. They said to us, employee 101, he pays 1132, or the company on his behalf pays 1132 to the medical aid, and so forth. So we have all the amounts here, and so we simply go and we put that in our answer sheet. Remember, the 2 part-time employees does not belong to the medical aid, and like we did every other time, we total the column. Okay, what about the pension fund deduction, or the pension, not the deduction, the pension fund that is payable, the part that the company is paying? Well, it told us that it is 7.5% of the basic. So basically now I can just refer back to this column, multiply it like I did there with 7.5%, and that will give me the answer. And then I can just pull that down. I won't do that. I've done it before, so I will just reveal it to you. And then you total. Okay. So now we say, okay, but what is deductible is the pension fund for both the employer and the employee. So logically, and I already said this to you, this column here will be 2 times the amount that we have in that column there. So we simply go and we multiply, we refer back to that column, and we multiply by 2. And then we have those numbers there, and like always, we then just go and we total. Okay, now we can calculate our pay-as-you-earn remuneration. Remember what I said? Salary plus commission plus the taxable value of the travel allowance plus the taxable value of the use of the company car plus the taxable value of the medical aid plus the taxable value of the company's pension fund contribution less the employee and the company's pension fund contribution. Look there in the formula bar. I've given you the formula. That equals the pay-as-you-earn remuneration. And I've done that for all the employees. Okay. And then when I total it, I see that the total salary bill at this point is, in terms of what we have to pay-as-you-earn on, is 214,119 for the month. Okay, now when we work with a UIF remuneration now, we are going to take this number that we just calculated, okay, and now we are going to subtract the commission because we added it before, and we are going to add the pension fund deduction because we subtracted it before. And for the purposes of UIF, these two, the pension fund deduction and the commission, are not brought into account. Okay, so if we do it for this first person, you will see that we get a value of 12,780. Now, 12,780 is obviously less than that amount that they gave us there of 1487, and because it is less, we put in the amount as we calculated it. Now, if we look at the next guy, his pay-as-you-earn salary is 93. So we already know that we can simply put in that 14,972 amount because it is way more. Same with the guy that earns 28, way more, no calculations needed. Same with the guy that earns 43, way more. So we can put in the 14,997. Now, when we get to this fifth person here, we see that his pay-as-you-earn remuneration is 13,883, and to make matters worse, he does get a commission, but the commission is small and the pension fund deduction is a bit more. So our hunch is that if we look at that amount and we follow our formula, we're going to get something a little less than the funding salary, and indeed it is. The minimum funding salary is 14,972, and he is paying 14,588. So we have to put it in the column. Okay. As far as the two part-timers are concerned, remember the one that worked for 34 hours will pay UIF, but it will be the same amount because there are nothing that we can add or subtract. And the guy that only worked for 20 hours does not contribute to UIF, so it will simply be naught. Okay, now we can go and we can add that column as well. And now we have to go and calculate the pay as you earn deduction for each one of these 7 employees. Okay, now this is how we do it. Now, what I've done here is I've put in here a little pay as you earn calculator because we're going to have to complete it for each of the employees. But I've made it easy for you. Okay, and you don't have this in your exam, obviously. You're going to work on your normal calculator, but you will see that the way I've done it is so that you are able to just either say plus or minus or multiply on your calculator as the next step every time. So we always start with a balance of remuneration. So now we are going to have a look at person number 1001. Okay. Balance of remuneration given or calculated by us as 12,544 cents. He gets a 13th check, so his pay periods are 13. That will give us his total pay. Okay, now to calculate the taxable income, we have to look at the tax table. The taxable income, we just bring that over like that, minus the foundation. Now, let me show you what I've done here. Let me just scroll a little bit down. Okay. On this page, or the answer sheet, I've restated the tax table. So the rate, so now I've given you the taxable income in one column. I've given you the rate in one column. I've given you the fixed part of that tax bracket in this column, and I gave you the foundation amount in this column. Because remember, it always says if the guy gets more than this, he must pay 26% on anything he gets more than this if he is in this tax bracket. Okay, so now I've just put it in there as fixed part and foundation so that I could use it in my calculator. That's all. Okay, if you look again at our question paper, it says 18% of taxable income. Let's quickly look at this. In this case, there's obviously not a foundation amount given. That would have been 0. And there's also not a fixed part. It's just 18% of whatever the income is. When we look at the second one, anything more than 195,850 will be taxed at 20%. So that becomes our foundation. And there is a fixed part there, and that is also given to us 35,253. So when I go and I look at my answer sheet where I've restated the tax table, those are the amounts that you will see there. Okay, let's get back to employee 1. Let's subtract the foundation. That is not there because we see that 163,077 is obviously less than 195,000. It's 32,000 less. So there is nothing to subtract there. And so our answer will still remain the same. Now we go and we look and we see that the tax rate in his case, we knew it already, is only 18%. And we know that the fixed portion is 0 because it's only 18%. So when we now calculate that, it should still be 29,353. So remember, we took what was in that column, we multiplied by the tax rate, and then we add the fixed portion. If you just go multiply and then plus, your calculator, if it's a good calculator, will apply the order of operation correctly. But if you are worried, you can use brackets. Then you can say, well, let me take the total pay that is taxable, multiply it by 29,000. Multiply it with 18%, put a bracket, say equal, write it down, and then add the fixed portion. But doesn't matter. So if you go there, times the tax rate of 18% will give you an amount. The fixed portion, as I said, in this case is 0. I'm going to do it for one more guy so that you can see it, especially the guy that earns a lot. Okay, so now he must therefore pay 29,000, but he gets rebates. Now we know, just remember, he's 57, so he's only going to get the primary rebate that I also just brought over here so that it makes my calculation easier. So he only gets the 14,220 rebate, and that gives us the amount that he must pay in the year. But he is paying only this month. He's not going to pay everything in one go, so we must divide it by 12, and then we see what he is supposed to pay on a monthly basis. But now he has medical aid expenses. It's really more the company that has the medical aid expenses, but regardless, the state is saying to themselves, hey, this is one more guy on a medical aid. He doesn't have to make use of the state facilities. That saves us a lot of money. So let's give the guy a couple of rebates. Well, in his case, only one. He's the only guy on the medical fund. Nobody else in his family is on the medical fund. So we only subtract that 310 rand. Okay, and that will give us his pay as you earn that is payable. Okay, see, there we've done it. Now, okay, you follow the same process for everybody, and you will get the answers. But now I just want to show you two more. I said one, but I'm going to show you two more. Obviously, let's actually go here and look at the two part-timers first. Remember, we simply take their pay-as-you-earn remuneration and we multiply it with 25%. So there's no other calculations that we have to do. So those two we can actually put in first, and this guy, we now did his calculation and we see that he must contribute 951. Let's see what happens to the young man of 32 that is making a lot of money. Okay, in his case, the balance of remuneration is, I must actually do this now, is equal to 93,528. Okay, that's a lot of money. Okay, he doesn't get a 30th check, so in his case, that's only 12, and that will give us his total pay now. Okay, his total pay for the year is 1.1 million. In his case, there obviously is a foundation, and it's quite a big one. Remember, see, he falls in this last tax bracket that they gave us, where the tax rate is 41%. So the foundation amount in his case is this 708. So let's say equals that amount. Put it in. Okay, that gives us at least 14,000. No, not least. That gives us 414,000. Sorry, guys, what's going on with my reading? 414,000 that he's paying on the amount above 708. So that's what are we looking at here? Another 450,000 about. Okay, so we take that 414 and we multiply that with his tax rate that is certainly not 18%, which is 41%. Okay, and he must pay that fixed portion that is indicated there. Okay, so he will have to pay in the year tax to the tune of 377,000. Now, luckily, he also gets a rebate. Okay, and his rebate is also just the 14,220 because he's only 32. Okay, and in his case, if we go and look at him, and now I will have to go back here to my question paper. In the case of employee number 2, he has 3 dependents. Okay, so when we do the calculation, we will have to say that this is equal to 310 plus another 310 for the first dependent, plus 209 for the second dependent, plus 209 for the third dependent. Okay, so the amount that he can deduct is 1038, and let's see if that agrees with our amount that we had there, but that was 29210. If I reveal it there, you see it is 29210, and so I know the calculation is right because it's what I got earlier as well. Okay. Then I'm not going to do it for employee number 3 because you've seen how it works. And I'm not going to do it for employee number 4 because you've seen how it works. But I do want to do it for this old man, employee 5005, because he is 75. He is somebody that's going to get all the rebates, primary, secondary, and tertiary. I didn't do this one for you now, the guy that's 69. Just remember, he will get both the primary and the secondary rebate. But let's go and look at employee 5005. Okay, let's have a look at him. It's on this row. Okay, it tells us that he gets this amount here of 13. Did I make a mistake in his case? I don't know. Obviously, oh yes, no, that was right. No, sorry, I did work it out, and it was just a little bit less than the funding salary. Okay, let's get back to what we were doing. We put down his balance of remuneration. Okay, let me say it's equal. Just undo that because I've done it before. Okay, so his balance of remuneration. Now that I'm doing it properly, is 13,883. So we put it in there. He does not get a 13th check, so only 12 pay periods gives us 166,597 and 80 cents. Okay, let's bring this in here. In his case, it's way less than the 195 again, so there will be no foundation. Okay, his tax rate will be only 18%, not 41%. Okay. And there is no fixed portion in his case either. Okay, so the total tax that he's paying at this point is 301,000 Rand per year. Okay, I did something wrong, guys. What did I do wrong here? That's correct. Multiplied it with 181%. I thought that's completely wrong. Okay, 18%. That looks better. So the total amount that he has to pay in the year, it looks to us this far, is 29,000. Now we apply the rebates. And in his case, he's getting not only the primary, but all the rebates. So it is equal to the 14,220 plus the 7,794 plus the 2,061. Those are the rebates that he is receiving. Total amount that he must now pay in the year is just under 6,000. And if we divide it by 12, we get 49272. But now we get to his medical rebates. Okay, let's go and look again at what we know about it. It is him and 2 other dependents. So when we calculate it, let's go back there. Let's get my bearings here. When we calculate it, we know that that is equal to 310 for him, plus 310 for the wife, plus 209 for the nephew that is still staying with him. Okay, so these rebates totals that he qualifies for is 829, which means that his pay as you earn is actually minus 336. Now, there is no way ever that SARS is going to give you money just because you're old, okay? So they do, it's called an old age pension, but he doesn't qualify for this. So because this is a negative amount, his amount that he's got to pay is simply 0, okay? And then we put the 0 in there. Like we've done everywhere else, when we get to the end of the column, we multiply it. We just total it. Okay. Now that we've done all the calculations and we added all the columns, it seems like we are done, but remember, we are not done because they told us that we must also complete the abbreviated EMP 201. Okay, so let's continue. We know that the skills development levy that is paid by the company is 1% of the STL remuneration, the total there. So we take that total and we multiply it with 1%. And when we multiply it with 1%, we get an amount just over 2,000. That must be paid to the Skills Commission, but we pay it to SARS and they will pay it over. Okay. The 83,000, that must be the funding salary on which the UIF must be totaled. That it comes to 83,000. But now remember, both the company and the employee is paying 1%. So therefore, we need to multiply that with 2%. I've put that for you in the formula bar already. And then we get 1,600 and a couple rand more. The pay as you earn, we simply use the amount that we totaled there, because all the pay as you earn must be paid over to SARS. So then, on the EMP 201, we will indicate the STL payment due to SARS, we will indicate the UIF payable to SARS, and we will indicate the pay as you earn payable to SARS, and we will total it so that we know exactly how much to pay SARS on a monthly basis. Thank you, guys. I hope you found that helpful.